America's debt has now grown so large that the annual interest on it now exceeds all the money the nation collects in taxes. This now traps the US in a no-win situation.
When I say get busy inflating or get busy defaulting, you quickly, when you see 111% of tax receipts going to just true interest expense, if they deflate, tax receipts are going to fall. And if they deflate and tax receipts fall, the US government and the Fed face a choice. Either the Fed prints the difference, which is already 11%, and it will grow as they deflate, or the United States government gets on TV and says, Treasury holders, we're not going to send you your coupon, or baby boomers, we're not going to send you your entitlements.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another week of making sense of money and the markets so that you can make better informed decisions about building your wealth. Suddenly, the world is in a state of high anxiety. In the US, the monetary and fiscal stimulus spigots are turning off as the Fed threatens to start tapering in November and Congress devolves into gridlock over both the next stimulus package as well as the debt ceiling. Outside the US, long-standing stable political regimes like Angela Merkel's party in Germany are voted out of control. Add to this rising energy costs, petrol shortages, and power rationing across the globe, and the road ahead looks downright scary. How will this turbulence resolve, and how are the markets likely to react? To shoulder the challenge of making sense of this all, I'm thrilled to welcome Luke Gromen back onto the program. Luke is the founder of the highly respected macro thematic research firm Forest for the Trees. Luke, thanks so much for joining us today.
Thanks for having me back on, Adam. It's great to be here again.
Good, good. Well, we got just huge kudos from our audience the first time you were on here, and there will be a well-deserved victory lap I'm going to let you take in just a few minutes here. But as we kick things off, Luke, I just want to ask the first question I asked you last time, but it's how I like to kick off these discussions. What is your current assessment of today's global economy and financial markets?
I think today's global economy and financial markets are in pretty uncharted territory. I think you've got a unique series of crosswinds, ranging from the first bursting global sovereign debt bubble in 100 years to peak cheap oil and gas, to supply chain problems, to geopolitical tensions driving a reversal of the disinflationary trends of globalization, so deglobalization occurring. You've got COVID on the more near term in terms of, I don't even know if we'll call it cyclical, but sort of more tactically that we've been dealing with and are maybe on the downside, maybe not. We've got some domestic political and labor market issues as a result of that. So when you sort of factor all of these things, and probably a few things that I forgot to list, but we'll probably touch on in the course of the interview, it's a very unique and potentially toxic brew. And so then it comes down to a question of, are they going to inflate or are they going to default? And I think ultimately that's what really, when you go to these big cycles, it's once you get to too much debt, it's inflate or default. That's it. That's the way you work your way out of these things. And so a lot of these factors are putting more pressure on this global sovereign debt bubble that was going to be a problem in coming years, really regardless of what was going on demographically with some of the entitlements, et cetera. But with everything we've seen that I just listed, whatever time horizon that we were going to experience those issues over has been compressed and brought forward. So here we are, and it really brings up this question of get busy inflating or get busy defaulting, as I tweeted the other day, to paraphrase one of my favorite movies, Shawshank Redemption. So,
all right. So great summary context of where we are. Let me just ask one question as a coda to that, which is, everything you listed there, we're They were risks. They were threats to the current stability of the status quo. How do they, if at all, justify today's record all-time high stock price or asset prices?
So I think, to me, it really comes down to where it's sort of least worst, right? So it's the old saw about when a bear enters the campsite, you don't have to be faster than the bear, you just have to be faster than the slowest camper. And so everything I just listed amounted to a really big bear entering the campsite. And so for me, when I look at asset prices, I don't think we can look at them as in a vacuum. I think we need to say, okay, which asset prices are faster than the bear? And I look at the bond market as sort of like, the fat, slow kid who's very unathletic.
Slowest camper. Yeah.
And he's going to have a really hard time getting away from the bear. And so if that's the case, the interesting thing is the bond market is, 130 trillion, 150 trillion dollars globally. It dwarfs all these other markets. Now we can make the case maybe residential real estate is well, even then, the mortgage market in the US is what, 10 trillion, 12 trillion, 14 trillion. So it dwarfs all these markets. And the point is that if all of this goes in a deflationary bent, these bonds are going to default en masse. You can make the case, I'd rather own capital structure, capital structure 101, I'd rather own the bonds than the equity if that's the case. However, with that said, if you have a mass default event or equity prices, asset prices fall in sort of this deflationary environment, sovereign tax receipts are going to collapse, and they're already running below fixed, what we call real interest expense, which is just the entitlement pay-goes plus the treasury spending in the United States, for example, is already more than tax receipts still with all the bubbles we have going on. So the punchline is that if they choose a deflationary outcome, then treasury bonds, sovereign debt, high grade AAA rated stuff is not going to be it's not money good on a nominal basis. Equities will fall further, no question, but then it comes down to, okay, what do you want to own? So bonds aren't a great outcome in deflation. And then if there's inflation, bonds are a terrible outcome. And so I think it really comes down to this view of, as I look at asset prices, it's not about do they make sense on a PE basis, on a price to sales basis, on a cash flow, enterprise. There's almost no historical metric on which they make sense in a vacuum. However, in the context of a global sovereign debt bubble where Western sovereigns in particular, the US in particular, needs rising asset prices to justify or to drive tax receipts, there's a political economic question, which is asset prices don't make sense if the US government is going to allow itself to default on treasuries for lack of printing money. And if the US government is not going to let itself default on treasuries and entitlements to baby boomers for lack of printing money, then the bond market's the fat kid who can't escape the bear. And we have been seeing for 10 years, as you look at the flows, money flow out of the $130 trillion bond market into stocks, real estate, Bitcoin, gold, sort of everything that's been rising faster than bonds have been rising over the last 10 years, last 5 years for sure.
All right. I like that framework of the bear at the campsite as we look at as asset classes, because it does have some explanative value for why things maybe have price pressure today that we don't think is being, justified in a rational world. The rationality goes out the window once the bear starts tromping through the tents. Right. All right. Well, I'm going to blow up my my long list of questions for you because we're already deep into it here. Before I do, though, I want to just give you kudos for the last time we had you on 7, 8 or so months ago. You did kind of make your call that you thought on the inflation versus deflation debate that inflation was more likely to win out. To be honest, I can't remember how much we got into sort of short-term versus long-term outlooks, but certainly in the short term, inflation really kind of came raging back right after that interview. So I want to give you, kudos for that. And if you were talking long term, then just be quiet, and we'll all assume you were talking short term. But I want to pull up a tweet of yours here because it's building on what you were just talking about. You say normally recessions cure shortages and high prices. However, for the first time in the lives of anyone reading this, a recession will also force Western and Eastern sovereigns to default on their debt and entitlement obligations. Get busy inflating or get busy defaulting. That's the reference to Andy Dufresne from the Shawshank Redemption.
Right.
So let's dig a little bit further in here. So if I understood what you just said a few minutes ago, it sounds like, sort of a binary path governments could go down here. They could go down the deflation route, which I was going to say I would think no country would willingly do, because no politician can really run on that or get reelected after that. But I will say China is being much tighter, adopting much tighter policies than at least the rest of the Western world right now. So they might be an important exception. But when you wrote this, just dig a little bit more into how, even if they want to inflate, are you saying even if they want to inflate here, that the next recession is going to force them to make these defaults on entitlements and on their debt? Or are you just saying they have to make that choice between either just let deflation ripple through or just print to the moon and meet all these obligations nominally, but the purchasing power might be nothing?
So when it really comes down to, and something we really focus on with, as it relates to that comment of get busy deflating or get busy get busy inflating or get busy defaulting, is we looked at a report that came out about a month and a half ago from the Treasury Borrowing Advisory Committee of the United States, or TBAC. So it's sort of a who's who of major executives in the private sector, in the bond markets, financial markets, et cetera, that advise the U.S. Treasury about issuance, what's going on in the markets, et cetera. And the TBAC issues a quarterly report, and it's a tremendous report. It's available to the public, and it sort of lays it all out there if you know what you're looking for. And so one of the things that we had noticed recently, and we've been tracking this for a long time, is we don't consider the U.S.'s interest expense to be purely the best metric, or the metric we should be looking at in terms of seeing where interest expense is relative to tax receipts, right? So if we take a step back and say, I've had multiple investing graybeards tell me, Luke, no sovereign has a problem until they have to print the money just to pay the interest on the debt, and then it's over. The market will react to that. You'll see high inflation. You'll see the currency weaken, et cetera. And so that was probably 3 or 4 years ago. Those graybeards pointed that out to us, and at that point in time, U.S. interest expense, particularly on a net basis, given the intra-agency stuff, was still de minimis because rates had fallen so low despite the high debt pile. And so sort of the headline read from most conventional economists is to say, see, there's no problem here. Our point is you can't look just at the debt, the interest on the debt. You need to look at the interest on total obligations. And so what we highlighted was, if you look at the interest on the debt, the Treasury spending is how TBAC breaks it out. And then you add to that what is effectively interest on the United States off-balance sheet entitlement obligations, which is not included in the debt, but is, call it $100 to $200 trillion estimated in terms of total obligations. The pay-as-you-go portions, the annual expense on entitlements, is effectively the interest expense to float those obligations. So what we started doing was adding the interest expense plus the pay-as-you-go portion of entitlements. And what we found was that number was far more troubling. So as recently as 2018, that number was 75%. And the punchline is post-COVID, between the Fed raising rates in 18 and 19, raising interest expense, nominal interest expense, between the demographics, between the Treasury spending, which they lump in the TBAC, the stimulus and some of this other stuff to basically keep the wheels on the cart. And then what entitlements have done, what tax receipts have done. The punchline is that right now, as of the third quarter of 21, true interest expense for the United States, Treasury spending plus entitlement pay as you goes, is 111% of U.S. tax receipts.
That's just crazy.
Even though U.S. tax receipts are at all-time highs, and those all-time highs influenced by all-time high asset prices across the board, because the U.S. Has allowed the system to evolve such that it is the marginal driver of tax receipts and consumption are both heavily dependent on asset prices. So it's incredible that you have this asset bubble across a number of different categories, but even with that, the Fed still needs to print 11% of tax receipts just to cover true interest expense, let alone defense at $800 billion a year, Labor Department, Education Department, veterans benefits, which are almost $200 billion a year now as a result of the bad policy choices, shall we say, over the last 20 years in the Middle East. All the other things that the government pays for are not included in that number. And so when I say get busy inflating or get busy defaulting, you quickly, when you see 111% of tax receipts going to just true interest expense, if they deflate, tax receipts are going to fall. And if they deflate and tax receipts fall, the U.S. government and the Fed face a choice. Either the Fed prints the difference, which is already 11%, and it will grow as they deflate, or the United States government gets on TV and says, Treasury holders, we're not going to send you your coupon, or baby boomers, we're not going to send you your entitlements. And politically, I don't think either one of those are palatable. Economically, neither one of those are palatable. And if we assume that neither of those are palatable, then we can, it's like the old Sherlock Holmes, right? Sir Arthur Conan Doyle. Once we rule out the impossible, whatever remains, however improbable, must be the truth. And so if we can rule out the impossible, which is that the U.S. government's going to get on TV and tell baby boomers they're not getting their money, tell U.S. Treasury holders they're not getting their interest payment or they're going to get haircut on it, if that's impossible, and we rule that out, then what we have left are one of a couple options. The most likely option is they've got to keep inflating everything, asset prices in particular, but that will trickle down, and government spending, particularly if it's goes for the real economy, will help inflate. There are some other options. They include some sort of big Manhattan Project type productivity driver, nuclear cold fusion that gets it rolled out and implemented over the next year or two, type of magnitude, something very revolutionary.
That's kind of and then magic happens.
And then magic happens. And, there's a more morbid scenario too, where basically you find a way to default on the boomers where, some portion of them, pass on, and their assets, say the boomers hold about $35 trillion in assets, it's estimated at, go from them to their kids, and their kids have a much higher marginal propensity to consume than the boomers do, just given age and demographics, and that drives some growth as well. But failing those two, if we rule out that they're not going to default on boomers or entitlements or on interest, then they're going to have to inflate. And that's really why I say, this cycle, we have never been in a position, at least going back to World War II, where the starting point of any recession is the U.S. government cannot make its interest payments out of tax receipts day one without the Fed's help. And that's never been the case before. And that's where it is. If you start from that first principle of analysis of everything we're watching, it's very eye-opening. It's very shocking to be blunt.
Yeah, God, so many directions to go in this. Just to add on to what you just said there, though, can you also say it's sort of unprecedented to be poised here, whenever the next recession hits, where the Fed really can't raise interest rates without kind of nuking the economy?
It's absolutely the case, and it really is. When you look historically at these inflations, historically the way they've been stopped is by the Fed tightening or invoking a recession, right? So we had multiple recessions throughout the 70s, right? You had this recession in 74, 75, you had recession, I guess not all of them, but so 70, 74, 75, 80, 82, throughout this inflationary period, the Fed was introducing multiple recessions to sort of stop it from just spiraling away. They can't induce a recession. They can't. And there's the appreciation of this on Wall Street at the moment is still very, very narrow. That they are, if they try to stop this from happening again, because even with all of this craziness and inflation and asset price, they're still not covering the interest vig. They cannot cover their fixed obligations without the Fed's help.
Well, so on that point, you talked about the gray-haired saying, "Hey, once the country can't meet its interest expense without having to print money, it's game over," right? You're basically saying that's the case by the calculus that you use, where you're combining both the interest expense and the pay-as-you-go part of the entitlements. So is it moot at this point? Like, has the Rubicon been crossed? Has the elephant been mortally shot, and it might just stomp around for a while, but that elephant's going to croak at some point? Are we there?
I think we have crossed the Rubicon. I think ultimately we were heading in that direction relatively rapidly. And then COVID happened, and post-COVID, it sort of puts you so far past on a number of these metrics as a result of the economic response, right? I mean, we could have deflated then, right? They'd say, hey, if we'd have just closed everything down, close it, you're going to have a massive defaulting of everything. You stock market would have gone to zero, basically, right? Because you can't have stock markets open and close the economy associated with those stock markets. What's going to happen is every business owner out there with a 401k is going to liquidate their stock to try to acquire dollars. And so they did what they had to do, they being the Fed and policymakers. However, that crossed the Rubicon from the standpoint of now really the only policy choice is to get that debt to GDP back down to a level from which the Fed can normalize policy without blowing up the economy. The problem is that requires, by our math, 20% nominal GDP growth for 5 years. And we're seeing global supply chains break down at 6%.
Right.
6% nominal GDP growth. Okay,
well, so sorry to interrupt, but this is really where I want to go, which is, if any of these words I put in your mouth are wrong, correct me. But it sounds like you say, look, if we're going to die in the fire of inflation or the ice of deflation, looks like it's going to be fire. In fact, the fuse has already been lit. There's no way of avoiding it at this point. We will end up in sort of a Zimbabwe type currency crisis at some point in the future. And it might not look exactly like Zimbabwe, but people understand that, right? It's that the purchasing power of the currency gets destroyed over time as you just print way too much of it. So that's the get busy inflating. But it's probably not going to be a straight line to there. And there are some very big factors that are right in our front windshield right now that may really slow down the economy. So when you talk about the importance of tax receipts, or we're talking about valuations, the inputs to those, which technically are earnings, the economy is now slowing down. It got juiced by all the stimulus that they sent out there, but it is now slowing down pretty quickly in a lot of parts of the world. I guess this could change, but just looking at what they're saying right now, looks like the Fed is going to be not issuing nearly as much stimulus next year as they did in the past 18 months. Congress is having a tough time getting its fiscal stimulus continuing. So we're going to have these big monetary and fiscal cliffs, but we then have the supply chain shortages that you talked about, right? We've got a debt ceiling shutdown coming up. Maybe that's, again, that's something that we have a lot more control over than some of these other factors, but there's a lot of things that are circulating right now that are saying, look, growth is going to slow, right? And I'd love your thoughts on that, just on the economic side alone. But then I want to get into potential constraints that the central planners have no control over. And that's sort of like resource availability, right? And we've got a lot going on in the energy market right now that I want to talk to you about in just a second. Sure. And no matter how many trillions you print tomorrow, you can't print up another extra barrel of oil or BTU of natural gas if it's needed right now. So,
Right.
anyways, how worried should we be about the monkey wrench that this economic slowdown right now could throw into things?
It's a big deal. I don't think the U.S. is, going back to your earlier point, I don't think the U.S. is a Zimbabwe per se. I understand the extremes inform the mean. So I do think that's directionally, that's the issue, right? Is you've got the U.S. has a balance of payments problem, and they have a balance of payments problem, and they have a central bank that can cover that balance of payments problem. And so that is an inflationary set of circumstances. If they choose to not cover that balance of payments problem, then it's extraordinarily deflationary, and it will be what we saw from March 9th to March 18th of 2020, which was stocks down, dollar up, treasury yields up. And that's sort of the Achilles heel of the whole system. If you get U.S. assets down and treasuries down with that, with yields rising into that, that's let that go for a few weeks, maybe a month or two, and that'll kick off a death spiral, just because of the leverage in the system and the centrality of the dollar and to the dollar system in the world. So I do think that's a big issue. Now, in terms of these new crosswinds that we're laying over it, I think they're a huge deal. I think you're 100% right that the Fed claims they're going to taper. We'll see. If they do, I think it's going to be an extremely short-lived and painful experience for them, unless they have some offsets to that. In other words, they can taper QE with the left hand, but if they implement standing repo facilities with the right, it's almost like a heroin addict shooting up less heroin with the syringe in the left arm, while they have an IV drip of steady state heroin in the right arm. And the answer is are they doing less heroin? They're probably not doing less heroin. So that's the thing you have to watch for. But on the face of it, if they don't do the IV drip, the standing repo facility, or other things offsetting the removal of liquidity that QE taper would represent, that's a problem. That's deflationary, without a doubt. The inability of Congress to be able to do anything on the fiscal side is discouraging, not surprising. Ultimately, once Nancy Pelosi, et cetera's, personal accounts start dipping back under 9 figures, they'll probably, get motivated properly to give something to the bourgeois. But until then, it doesn't look like they're going to get something done, and that's also problematic. And then to your point, you've got China looking like they are really tightening as it relates to the property markets. And that's problematic because you look at the marginal buying of commodities, marginal economic growth. I mean, people forget the reason we got out of the 2008, the 2008 crisis was because the Chinese ramped up property spending, right? So like this is sort of the deferral of pain from 08. As painful as 08 to 10 were, they'd have been a lot worse if China didn't do from 2010 till last year what they've done with property markets. And now they're trying to tamp that down. And so it's unclear to me what the contagion effects could or will be. But very clearly, I think they could be substantial through the real economy contagion. In other words, when the day the phone stops ringing as a multinational supplier of building supplies into China, or raw materials into building supplies, that's going to be a scary day. And that'll be a day that the phones stop ringing right on down the line. I read this great line in a book I'm reading called The Long Game by Rush Doshi. It's about China. But he brought up the point that at no time in American history has any adversary or group of adversaries, the Axis powers in World War I, Axis powers in World War II, the Soviet Union at the height of their economic power, at no point did an American adversary or group of American adversaries ever total 60% of US GDP. And China surpassed that in 2014. So this is another way to add to the list that I talked about, and I'm sure there's some things I'm leaving out, something we've never seen before in American history. We have an adversary, a competitor, who is more than 60% of our GDP. And so if we have this slowdown in China that appears to be happening in construction markets, the odds that it goes global through basically supply chains into an economy that is highly levered, so it'll supply all the leverage you need to create a contagion elsewhere, it's a real issue. And so the question, to your point, is path. Can we get deflationary periods? I think we can. I think they will continue to be sharper and more brief with each passing instance. And then I think at some iteration of this process, they'll just stop going down altogether. Bad news will immediately mean bid stocks, bid assets, which at that point, policymakers will have completely lost control. And we can see this shorter, sharper has been happening for 3 or 4 years, 5 years. I think that's my working assumption, is like whatever deflationary impulse we get out of this, it will probably be sharp, it will probably be brief, and then we'll get into this, hey, whoops, the Fed's going to do 3 trillion more in QE. It's not tapering, actually.
Yeah, and that's really one of the main reasons why I asked that question was everybody watching this video is trying to figure out what's coming so that they can position prudently for it. And I think that's what's so tough about the time we're in here is maybe the end game is actually relatively easy to predict, but the path towards it is not. And you can't just predict for the long term. You can't just position for the long-term inflation today, because you can get wiped out by these deflation punctuated periods that happen in the interim. So sadly, you're just forced to have to watch the game and have to play the game. Yep. Before we hop off China, I'm not a China expert. I've talked to some people recently on this program who are pretty knowledgeable about it. And I'd love to get your thoughts on this. So Prime Minister or Chairman Xi there seems to be, you could interpret the choices he's making there right now is basically seeing the same future outcome that you've just laid out there and saying, rather than running into it, doing 100 miles an hour, hitting the brick wall, I'm going to try to slow down and try to manage this crash. And I'm going to kind of try to crash early, maybe, take the pain in bite-sized steps early. One, I want to know if you agree with that, and two, if China really does intentionally kind of throttle down, does that exacerbate the problems here for the U.S.? Both in terms of trading partner, flows of capital, purchaser of our treasuries, et cetera. Like, if China decides to do that, does that actually exacerbate the pain that we're going to feel?
Yeah, I'll take the second half first. I think absolutely it does. Ultimately, anything, anywhere that slows down is going to pull forward this global sovereign debt bubble bursting that's already underway. It's going to basically pull forward the day even sooner that basically central banks have to move towards something that looks a lot like direct monetization of the debt. The question then gets into, okay, who goes over the cliff first? And there's a lot of debate about that. At the end of the day, because of the leverage, because of how big China is in the manner which I just described a little bit ago, to me, it really is a case of sort of, Michael Lewis probably had the best descriptor, the best metaphor for it in The Big Short, where he said, all right, it's a fight to the death in a boat between 3 guys or 2 guys, and one guy kills the other guy, finally bludgeons him to death, and then tosses him overboard, only to find that he's tied to him at the waist. And I think it's something very similar here. And I think there's still a lot of market participants, or many market participants, that think the rope tying together the U.S. and China and Europe is half mile long, or a mile long, or 5 miles long, like it was earlier in their careers in the late 90s, right? When we had 6, 8, 12 months from when Southeast Asia went over the cliff to when it showed up in U.S. industrial growth. And unfortunately, given the relative sizes and how much higher debt is, and how much bigger the U.S. is, how much more negative the U.S.'s net international investment position is, in other words, how many more assets they own of ours now than they did then, I think that rope is 6 feet long, 8 feet long, 3 feet long. I don't know. Basically, if anyone goes over the cliff, then the other guys are following.
The rest are going
in short order. And so it's a little bit of a academic discussion of who's going to run into the wall first, because or go over the cliff first, because as soon as the first one goes over, the pace at which the others start moving toward the cliff is going to accelerate, and they're going to be right over the cliff and falling as well. So I think it absolutely matters, to answer the second part first. In terms of what do I think she's doing, I would defer to those people on that. That makes some sense. I think he is seeing some, from what I've read, some social stability issues in terms of the gaps in wealth inequality and real estate getting to be too big a part of the economy, and they're trying to sort of manage that process. It's difficult to do, as we've seen, certainly in certain areas with ours, to do it in a way that doesn't create more problems than it solves. So that seems to be the issue. I do think some of the other things we've seen about the direction of the economy they've looked to take, whether that's sort of pre-building cities with the ghost cities, et cetera. I think was an acknowledgement of the relative valuation of resources at the time relative to the relative valuation of dollars and treasuries. I think there was a really good article in Wall Street Journal maybe 2 months ago about Xi saying that they would rather have an economy built on semiconductors and manufacturing and production than on building the best ride-sharing app, which I thought was a direct shot at the United States,
Yeah.
right? In terms of, where our economy has been evolved to basically, hey, let's create the next sort of, unicorn, right? A tech unicorn versus something that's more production driven. So that would make some sense, but I would defer to those folks on that ultimately, in terms of what she might be trying to do in terms of directing a slowdown in the economy.
Okay, great. Look, I could talk about this all day, but I got a bunch of other questions I want to try to squeeze in our remaining time here. Let's get into energy. And I initially was going to ask you about oil. You had a really interesting comment here on Twitter that I want to get to in a second. But beforehand, the world's kind of suddenly fallen into a panic around energy in general, really just over the past weekend. All of a sudden we've had natural gas prices shoot the moon over in Europe, and Europe suddenly can't get enough of it. You're having petrol lines in the UK. China's suddenly implementing rolling blackouts in its cities and saying, hey, folks, this is going to be the new normal going forward. Get used to it. What is going on right now?
I think it is a little bit. I think ultimately what's going on is peak cheap oil and gas is what's really driving it. And something we've been writing about for a while for our clients has been highlighting this structural problem, which is, if you look back in time at global oil production, for example, the world has produced very little new oil since 2005 if you X out the growth that we saw from U.S. shale production. And so ex-U.S. shale, global oil production has not risen much. The underlying fundamental problem there is something that Matt Simmons highlighted 16 years ago in his book, Twilight in the Desert, about Saudi oil production, the potential that you could see a peak and roll over in Saudi oil production. And the issue that he repeatedly highlighted was a surprising amount of global oil production comes from a surprisingly low number of fields. And I'm going to get the numbers wrong, but it's something like 25 or 30% of the world's global oil comes from like 100 fields, and they're on average 60 or 70 years old now. And the average age of an oil field is 40 or 50 years. And so you've got, they're what he called super giants and giants in terms of their production. And they're really, really old. And the geology of an oil field is pretty typical. It follows some element of, what M. King Hubbert called the Hubbert's curve or Hubbert's peak, right? It's a bell curve. You find it, you tap it, production rises up. At some point, you get to a maximum level of daily production, and then it falls off at some rate. And there are things you can do to lengthen that, to mitigate that, there's a number of geological things you can do, but you can't really avoid that. And so underlaying all of the sort of excitement about shale over the last 10 years has been this still peak cheap oil problem. And the issue with shale in the US is that it was really a function of expensive oil, cheap money, and an incremental technology gain of the steerable pipelines, right, or steerable fracking pipes. And so that, fracking was around 25, 30 years ago. They knew where these fields were 25, 30 years ago. Oil wasn't expensive enough, and having the long run steerable lines allowed the productivity gains. But the issue with shale is that it's the curve for that looks like it's like a straight line straight up for the first 3 months, and then it falls off rather rapidly. And so the more shale you produce, the faster you need to find and produce more shale, which means you need to keep finding better and better fields. The problem is the fields are getting less and less productive. They've already produced a lot of the A fields, they're onto the Bs and the C fields. So they've high graded a lot of their production. And because we're now at whatever we are, 15 million barrels a day, 14 million barrels a day, I don't know what the number is, but it's a huge number. It's a huge success story. But the issue is that once you get to that level of production, the amount of new production you have to go just to keep flat is staggering, and we're not doing it. And so we sort of had this intervening time from, call it 2010 to 2020, where shale sort of bought us some time, and we're out of time. And so now, the gas is there, the oil is there. It's a function of price. The price is going to have to motivate discovery. I think there's also been some policy issue around green and climate change and ESG that is not making things easier for these companies. But I think ultimately the real crux of the issue is peak cheap oil and gas is here.
All right, and this is what I used to talk about a lot at my former life before I launched Wealthion. So you're right in the bullseye of my interest area here, Luke. And folks, the reason why this is so critical is because without energy, you have no economy, right? They do not exist independently as much as we would love for them to. Energy is called the master resource because literally nothing happens without it. I don't know if you're familiar with Art Berman. He's a very seasoned petroleum geologist. We've had him on the program before. He actually predicted the higher prices earlier this year, predicted the higher prices that we're seeing now. But he has referred to the US shale miracle, as a lot of people called it, as basically the US oil industry's retirement party. Where it was just this great but very short-lived bonanza, as you just described, where we went after the cheapest and easiest to extract shale wells, and as you mentioned, they deplete very quickly. They deplete asymptotically, not at all like Hubbard's conventional oil peak.
Right.
And we burn through all the good stuff, and we just have to keep running faster and faster to get what's left, as you mentioned. And they call that situation the Red Queen syndrome. Yep. Where in Alice in Wonderland, she said you had to keep running faster and faster just to stay in one place. That's exactly what you were talking about. And I think it's also directly comparable to the inflation situation that you were talking about, which is as our debts increase and the interest on servicing those debts increase, and as our obligations increase, we have to not just print to meet those, but we have to print ever more every cycle to try to meet that stuff, and really just to stay in the same place. And it seems like we are sort of stuck in this kind of doomed trajectory, both on the economic side and on the energy side here. Do you agree? Long term?
Yeah, I mean,
short of someone coming up with fusion, unlimited free energy.
You're right. Yeah, and this is why I say some of these crosswinds are so bad. I mean, ultimately, it's important to remember that what's normal for the spider is chaos for the fly, right? So doom is going to be where, depending if you're a spider or a fly. With that said, I think the status quo of what a lot of us are used to, I think that's probably doomed in a lot of ways.
And I didn't mean to be, salaciously negative, but I think writ large, we all want an economy and we all want to use energy.
Right. That's right. It's the demand for energy is infinite, right? If I could take a helicopter everywhere I went, or a G5 and to fly around the world whenever I wanted, there's always demand for energy. But when you have debt as high as we have it, you need some sort of increase in productivity to both service the debt and maintain your living standards. And the problem is the energy return on invested energy, right? So how many barrels of oil effectively we have to invest to get a new barrel of oil has gone from, 100 years ago, it was 100 barrels we get back for every barrel we put into the ground raising oil. And that number's fallen dramatically. Some estimates are it's into the high single digits, right? So that is a decline in productivity at a time where we need an increase in productivity to both service the debt and increase our living standards. And so in the intervening time, you could make the case since 1970 when we went off the gold standard, certainly since the 80s, the release valve has been interest rates. Interest rates down, 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 right? And so, yes, the productivity of our energy supply was falling as our debts were rising, but the servicing cost of those debts were falling by rates falling towards zero. And so it all kind of worked. Well, once you get to zero on rates, that release valve, maybe you can go slightly negative as we've seen in Europe and kind of hold things together for a time, but you can't go to -3, -5. I mean, the amounts of financial repression needed to make the math work, they are doomed for the bond market, right? I mean, the increasingly expensive oil with the combination of increasingly rising debt and rates already at zero, you need basically some idiot to hold debt at increasingly negative nominal rates, right? So who's the idiot who's going to hold 20 trillion, $150 trillion in debt at -3%, right? If you hold 100 trillion for round numbers at -3%, you've got to come up with $3 trillion a year. You're going to lose 3 trillion in value every year. Who has that balance sheet? And the answer is nobody. Well, that's not true. Central banks have that balance sheet. Their balance sheet is infinite because when they create currency, they create both an asset and a liability at the same time. So their balance sheets could go to quadrillions, quintillions, whatever they wanted to. But in that world, that I think then reverberates or references back to your initial point about asset prices. Like, okay, well, in that world, I can't hold debt. Debt is the first thing when I say spider or fly. What's the fly in that world? The fly is the bond market. The bond market's going to get eaten by currency depreciation because we don't have the energy production to service the debt and grow our living standards. So they're going to have to produce currency units to basically paper over it. And if that's the case, I want to get out of bonds and I want to get into anything but bonds that better preserves that purchasing power as they create those currency units to paper over what at its fundamental base, I think, is this issue that you're highlighting, which is the productivity of our energy supply is decreasing. You've got a peak cheap oil and gas problem.
Right. You've basically got an intractable deflationary force there that while you're trying to inflate is just, forcing you to inflate even faster. And so here's kind of where I'm going with this, which is you've said, okay, look, given what we just talked about, which I think are real facts, right? Which is cost of energy is going up. Energy resources are going to become more dear going forward. We've already got massive, I'll use the word insolvency issues. You can pick a different word if you want. We're not inventing that. That's just the reality on the ground. So, you're saying, look, projecting all that forward, bonds is a place you do not want to be for all the reasons that you've just enumerated. I'm going to go back to Zimbabwe just for a second, not because I think we're necessarily going to follow the exact same path and speed, but the stock market went up a lot, in Zimbabwe, but it didn't go. But the pace or the rate of currency devaluation surpassed it. So even though you were, having increasing equity prices, you were still losing purchasing power by owning stocks. So do you see potential for that as well here? And are there certain asset classes that are even better positioned for the type of future that you see coming?
Yeah, I think if you look at some of these.
We hope you've been enjoying this discussion with macro researcher Luke Gromen. The interview continues over in part 2, where Luke provides a breakdown of the asset classes he favors for the current market environment. He also explains why he remains optimistic for the future prospects of both gold and Bitcoin. To watch part 2, just click on the link provided in the description of this video below, or go to youtube.com/Wealthion. But before you go, please don't forget to hit the like button and then click the subscribe button as well as that little bell icon right next to it if you haven't already. It only takes a second and it really does help us out. As the more subscribers this channel has, the more big name experts like Luke we can attract onto this program in the future. And if you'd appreciate a free, no strings attached portfolio review by a financial advisor who can help manage your portfolio with the risks that Luke has highlighted here, just go to wealthion.com and we'll set one up for you. Okay, I'll see you over at part 2 of our video interview with Luke Gromen.